Two people, the same car, wildly different insurance bills. Here's the gap. Same make, same model, same year. One driver pays noticeably more than the other every single month. And it's not random. Insurers run each policy through a formula, and that formula weighs dozens of inputs differently depending on who's behind the wheel. Here's the part that matters. Some of those inputs are basically locked in for now. Your age, your zip code, your credit-based insurance score in the states that allow it, the make and model of the car itself, your claims and driving record. Those move slowly, if at all, and mostly sit outside your control on any given day. A sports car with a bigger engine tends to cost more to insure than a sedan, with the same driver behind the wheel, and that's true no matter how carefully you drive it. But a chunk of your bill comes from choices you're actively making right now today, without even realizing their rate decisions. That's the part worth understanding, because it's the part you can actually act on. Let's start with mileage. Insurers care a lot about how many miles you actually put on a car in a year, because more time on the road statistically means more exposure to a claim. A person who drives to an office 5 days a week and racks up long weekend trips is going to look different, on paper, than someone who works from home and drives a few times a week for errands. The honest number here is wide. Annual mileage bands used for rating vary a lot by insurer, so don't expect a clean, universal cutoff. But the direction is consistent. Fewer verified miles tends to move you into a lower risk bracket. If your driving habits changed, new remote job, a move closer to work, a second car in the household now doing the errands, that's worth flagging, because your policy may still be rated on old assumptions. One more thing about mileage. Insurers don't just take your word for it forever. Many ask for an odometer reading at renewal, and some offer usage-based programs that track your driving through an app or a small plug-in device. If your mileage has genuinely dropped, that's worth getting on record instead of letting your policy renew on an old estimate. Now here's a question worth sitting with. When's the last time you actually looked at your coverage limits instead of just renewing on autopilot? Coverage choices are the second lever, and they're squarely yours. Liability limits, comprehensive and collision, rental reimbursement, roadside assistance. Every one of these is a decision, not a default. Higher limits and more add-ons mean more protection, but they also mean a higher premium, because you're asking the insurer to absorb more potential payout. Think about liability limits specifically. Every state sets a minimum, but a minimum is a floor, not a recommendation. It's the least you're legally allowed to carry, not necessarily enough to cover a serious accident involving another person's car or medical bills. Carrying too little isn't really a discount. It's risk you've just moved onto your own shoulders if something goes wrong. This isn't a push toward stripping your policy down, either. It's a push toward matching coverage to what you actually own and what you could actually absorb out of pocket. Full coverage on a car that's worth very little on the resale market is a common way people quietly overpay. The payout is capped near the car's value no matter how much premium you're putting in. Third lever, your deductible. This is the amount you agree to pay out of pocket before insurance covers the rest of a claim. Raise it, and your premium usually drops because you're absorbing more of the small to medium risk yourself. Lower it, and you're paying the insurer to carry more of that risk for you. A jump from a lower deductible to a higher one, say a few $100s up, is a common example insurers use, and it tends to lower the premium sum. The exact amount varies by insurer and state, so treat any number you see as a rough guide, not a promise. There's a real trade-off here, and it's personal, not universal. A higher deductible only makes sense if you actually have that cash sitting somewhere accessible when a claim hits. Otherwise, you've just traded a predictable monthly cost for an unpredictable emergency one. So here's the honest summary. Your age and location set a baseline you mostly can't touch quickly. Your mileage, your coverage choices, and your deductible are levers you're already pulling, whether you're paying attention or not. The people paying less usually aren't lucky. They've just looked at those 3 levers recently and adjusted them to match how they actually live and drive now. None of this tells you what you'd actually pay. That depends on your driver profile, your vehicle, and your state, and it's going to look different for everyone. Want to see where your rate stands with your mileage and coverage dialed in the way you actually want them? The link below shows you how to compare.